This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. There's a great video easily found called The Four Horsemen. It includes Richard Dawkins, Daniel Dennett, Sam Harris, and Christopher Hitchens. Hitchens is no longer with us, unfortunately. What a great conversation. Four very skeptical men sharing a 2-hour conversation about faith versus reason. Now, I really don't care what your faith is, whether you have a faith, whether you don't have a faith. But in my world, the trading world, reason wins. Logic wins. There is no faith in the trading world. If you have faith in the trading world, you are already done. You are put at the little kids' table. You don't get to sit with the adults. You're over to the side, perhaps getting like canned spaghetti or something. Little raviolis from a can. Chef Boyardee, yeah? This is what you get. No faith in trading. But I love this 2-hour conversation with these four men, all authors of brilliant books. You might be saying to yourself, but Mike, you're saying these four men that present themselves as atheists are all brilliant. I don't profess to have enough experience or enough insights in all matters by any stretch of the imagination. But give this 2-hour video of these four men a chance, just to see how they think, how they go about skepticism, rationale, logic, debate, argument. To me, that type of thinking in their video is foundational to good trading, to good investing, to good decision making. Because there is no such thing as certainty. There is no certainty. It doesn't exist. Uncertainty is what we have. What's a great way to make decisions in the face of uncertainty? Flipping a coin. Let me play an audio excerpt from BBC with Freakonomics expert Stephen Levitt.
Essentially, we put out the word that if you had a big problem that you were trying to solve, you could come and we would help you. We would help you decide whether you should get a tattoo or go on a diet or quit your job or break up with your boyfriend. Any question you wanted, didn't matter. And we tried to, through the questions we had, help people think differently about the problem so maybe they could come to some resolution. Okay, but many people, even after having done that, still couldn't decide what they should do. And then we did the ultimate favor to these folks, which is that we decided for them. We flipped a coin.
Now, Steve, there is actually someone in the studio with us, my producer Laura Gray, who's putting her head in her hands. I'm going to take a coin out. Laura, would you mind coming on the mic? Steve, I'm going to give you a coin. Now, Laura has a decision, so tell Steve all about it.
Okay, so my decision is, should I or should I not move in with my boyfriend?
Okay, so if you had to decide today, which way are you leaning?
No.
You're leaning no. Okay, and have you in the recent past been leaning yes, or you've been leaning no the whole time?
Been leaning yes.
Okay. One thing I think that's helpful in decision making is to first think about if you move in and the worst case scenario, and think about how bad that is and how much regret you'll have, okay? And then think about if you don't move in, the worst case scenario, and kind of how much regret you have. Because I think that that's not a crazy way to make decisions, is to say, I'm going to take the path where in the worst case, I will have the least regret. So is there one path or the other which feels incredible, like we would have the most regret?
I think I'd have more regret if I didn't move in.
Okay, so heads is going to be move in, tails is going to be not move in. You ready?
Yeah,
So
ready.
we also do a very important option on the website, which is to offer best 2 out of 3 if you really want to make sure the gods don't make a mistake. Do you want the 2 out of 3 option, or you want to go with just one cost?
Just the one.
Okay, here we go. Heads you move in, tails you don't. Here we go. What were you hoping for?
This is so embarrassing on the radio. I was thinking yes.
You're hoping for heads? It was heads.
There you have it, their ultimate tool for decision making, flipping a coin. And what's incredible is that more than 40,000 people have used this site to make decisions. Levitt admits that even with 8,000 people changing their minds on the toss of a coin, he doesn't have statistically robust results to tell us that, for example, if in doubt, we should change direction in life. But he argues that other evidence from economics and psychology suggests that we do tend to be too stuck in our ways.
I think the biases that humans have suggest that there's not enough quitting going on. Changing the path that you're on. Even though today I feel like I should change, I think to myself, okay, I could change today, or I could stick with it for one more day and I could quit tomorrow. And one of the benefits, if you want to call it, of this little coin toss experiment is that the coin toss is actually, this is a case where I think you could argue from a behavioral economics perspective that imposing a constraint, forcing someone to actually decide today, I'm either going to quit or I'm not going to quit, has a real benefit to the person.
Stephen Levitt. So if you have a big life decision to make, why not try flipping a coin?
That type of thinking, that type of decision making is exactly in the trend following philosophical construct. That's it. Uncertainty, but forcing yourself to make a decision. You take the trade when you really don't want to take the trade because intuitively, instinctively, it doesn't feel like it's a good trade. You take the trade because you know the rules are putting handcuffs on you to do a certain thing that you don't necessarily feel you should do, perhaps. I love Levitt's comment. There's not enough quitting. Think about the trading world. You take a position. It goes against you. Getting out is quitting. Getting out is quitting. There's nothing wrong with quitting. You're trying to preserve capital. And I'm going to play a clip in a second from someone that thinks very differently about this. So quitting is a good thing. Quitting keeps you in the game to come play another day, to show back up, to try again. But a coin flip decision-making criteria, as they mentioned, forces one out of a comfort zone. We think we know how to make good decisions for ourselves, but we don't. This is why Daniel Kahneman won the Nobel Prize, why Vernon Smith won the Nobel Prize, why Robert Shiller won the Nobel Prize, because they showed that we don't necessarily know what's best for us. We make decisions based on our little internal human fears and desires and want and greed, and we're often not right. I did a podcast recently where I quoted Michael Crichton, the famed author. Many of his books became big Hollywood blockbusters. And he has said, in court, there is the legal doctrine of falsus in uno, falsus in omnibus, which means untruthful in one part, untruthful in all. This excerpt I'm going to play now, you're probably thinking, what was that setup about untruthful in one part, untruthful in all, and now you're going to play a clip, so this must mean that everything you're going to hear is untruthful. Not exactly. Let me set this up. This excerpt is from Barry Ritholtz's podcast. I consider Barry a friend. He's a skeptic. He has a huge network of individuals he knows across the industry. Some of those might have competing thoughts or interests, but I think it's pretty clear that Barry has a distinct point of view. In this excerpt, he is interviewing an advisor to advisors a gentleman named Nick Murray. I do not know Nick, but I was turned on to this particular excerpt by a reader of mine. Let me play the clip.
So let's talk a little bit about risk and reward. All right, because risk is something that a lot of people have a tendency to think about, sometimes incorrectly. How should retail investors think about risk?
They should define it, first of all, and retail investors can't. The retail investor, and this is a huge part of his problem and his desperate need for an advisor, the individual investor cannot distinguish between risk and volatility.
I was going to say, everybody uses volatility as a proxy, but volatility really is not risk.
Volatility has nothing to do with risk. Risk is the chance of a permanent loss of capital. Volatility is unpredictability, both high and low, around a long-term trend line. One thing with the other got absolutely nothing to do. And this is far out breaking news for the American individual investor.
You're not going to find any disagreement from me. One needs to define risk. Risk is how much you can lose, quite simply. We're all in agreement there. But retail investors can't figure out risk, so they thus need a financial advisor that will take fees from them. And we all know that the financial advisors are simply giving mutual fund advice, and the vast majority of these mutual funds can't beat the S&P from a buy and hold perspective. So, of course, Nick and I already share a disagreement. Continuing.
Why does anybody get out at the bottom of the market? Because he looks at a temporary decline, because they're all temporary declines, and he says, I have lost X% of my money. In fact, he has not lost anything unless and until he sells. This is a distinction that, in my experience, people cannot make without an advisor basically standing athwart their portfolio going, stop.
Well, Nick and I are going to continue to disagree. An advisor is going to help how if there is a bear market in equities. I mean, right from the tone of what Nick is saying, you believe, I'm not putting this thought into your head, but you know that Nick believes deep down the only option that exists is to buy and hold stocks, and they will only go up forever. And that's your option. Now, of course, the Japanese don't believe this from a buy and hold perspective. Look at their markets back to 1989. They're still 50% down. The question becomes for you. Do you just believe the dogma? Or, like in the first clip with Stephen Levitt, do you possibly insert some thought for uncertainty? Will the dogma of the financial advisor and their mutual fund recommendations always be there for you and always win out? Will there always be a zero interest rate policy? Perhaps it will go to negative interest rate policy, and that will always keep the stock market levitated. So you will have a nice, easy retirement. I do find myself getting passionate about some of these issues, but it just strikes me that there's another side of the coin when I hear someone like Nick Murray talk. For everything we have seen since the dot-com bubble, to just simply say, it will all come back. Don't sell, hold on, it will come back, like we all live forever. Continuing.
We're speaking with Nick Murray. He is the author of 11 different books on finance and an advisor to the advisor community. So let's go over some of the worst mistakes that investors make. You hinted at a few of them. They end up getting enamored by things like IPOs. They get aggressive at the top. They panic at the bottom. Really, a lot of this just comes down to emotions, doesn't it?
Sure, it all comes down to emotions.
They give into emotions. They get excited. They get enthusiastic.
Or they get terrified. Or they get greedy.
Hey, that's easy to agree with. We're all three of us are on the same page. Barry, Nick, I, greed and fear. Look, that kind of stuff we all agree on. The issue is the solution. What's the solution? And look, I'm never somebody that's going to say the solution is necessarily this particular advisor or this particular fund. Ultimately, it's a personal responsibility issue, and we all have to determine what strategy are we going to execute. It's not about trusting someone else. Now, there are plenty of people out there that you can trust, and they will do a great job for you. But that comes later in the conversation. The first part of the conversation is strategy. So if we have greed and fear, what are the strategic options? Continuing.
So let's talk a little bit about greed. What about private equity and venture investing and hedge funds? They sound so sexy and sophisticated. We've been anecdotally hearing more and more questions about that from different people. What are your thoughts on those areas of investment?
I haven't really studied those areas, but if you find one that has outperformed mainstream equities over the long term with anything remotely like the volatility of mainstream equities, I'll be interested to learn about it. I haven't found one yet.
As a quick note here, I don't know anything about, I don't study about. Clearly, that's the setup for a very strong view to follow.
The things that you're talking about basically are very subject, in my experience, to vogues.
Absolutely.
And so, you would go into the crash of 2007, 2009 with maybe $200 million, $250 million in total in commodity futures funds, and you would come out of the crash with $2.5 billion.
Now, of course, Nick has those numbers wrong. He's not accurate in those numbers. 250 million, a couple $100 million in trend following trading during the crash of '08. That might have been with one trader. Now, I'm not necessarily going to sit here and pick on him for his memory of these particular data points. I screw up data points all the time. But he's pretty damn forceful, and he's pretty damn strong about his opinion. Continuing.
Because momentarily that stuff had held up better than mainstream equities. So what did everybody do? They took all of their money out of mainstream equities somewhere near the bottom and invested it in whatever you call these things, futures, managed futures. I don't even know the terminology.
Come on now. You don't know the terminology? Continuing.
At a time when there was so much money coming into these things that they could not possibly perform. And it was ever thus.
Now, Nick and I do share a belief on this aspect of thinking. If you don't decide for yourself and you just trust the system and you blindly jump from here to there and you don't have a plan, if you invest all of your money in some trend following fund after it's had a massive run, and of course we all know trend following goes up and down. In the long haul, it goes up, but it goes up and down. So if you are trying to jump from one asset class to another and you don't really have a plan, well, I'm in complete agreement with Nick. Continuing.
I don't manage money today, but if somebody came to me and said, I want to put a third of my money in managed futures and private equity and all this other stuff that you mentioned, I would say, these are not areas that I know anything about.
Does that strike you as odd? He's got some pretty damn strong opinions, but he doesn't know anything about them. Continuing.
They're not areas that I'm interested in knowing anything about.
Well, again, very strong opinions and zero interest in the subject. So even if a great strategy could be shown to Nick, it's got all the evidence in the world, the historical evidence going back decades, he doesn't care. Continuing.
Deep down, without adopting the burden of proof, I suggest to you that I have never seen evidence that these things consistently outperform mainstream equities over the long term, but it is your money and you're the client, and you should go find somebody who is good at, or that you think is good at counseling you in these areas, because I will never be.
I'm sure Nick is a fine guy, but he seems to have one job and one job only. Talk up buy and hold as your only option. Anyone that has looked at, quote, traditional stocks or buy and hold since the 1990s knows this particular strategy is majorly fraught with danger. 250% drawdowns in the last 15 years. Will there be a third? Of course there will be a third. Can I tell you when? Of course I can't. No one can predict tomorrow. That's the whole point here. It gets back to the uncertainty part. And I did insert that legal quotation from Michael Crichton to apply to Nick. Because if he is wrong in one part, it makes me want to say, why do I want to listen to another part? If he doesn't accurately understand what a trend following investment is, if he doesn't understand accurately what the historical track record is, if he has no interest, but he has very strong opinions, why do I want to listen to him? Look, I could honestly look at a buy and hold investment and say, yes, for those people that don't want to think at all and just want to say, you know what, I just want to put my money somewhere. How can I tell them that buy and hold is wrong? Just take the averages. Hopefully it will go up. Hopefully it won't look like the Japanese stock market. And you'll have a little bit of money, perhaps a lot of money, perhaps no money when you get to retirement. But for those people that say to themselves, damn it, the system has not been very kind to me. The system is currently predicated on zero or negative interest rates and stocks at all-time highs, completely engineered by the Federal Reserve. Can they keep that up forever? Will they have it up forever when you want to cash in your stocks for your retirement? These are all legitimate questions to ask. I'm sure it's one of the reasons that Barry asked Nick about other forms of producing alpha. Venture capital, private equity, managed futures. The buying and holding of equities is not the only game in town. And I confess, I don't pay attention to guys like Nick. Frankly, they bore me to tears. You get these guys that have been around Wall Street for 30, 40, 50 years, and they just have these views that are just like, buy and hold is it. There can't possibly be 30 years of stocks underwater. Can't possibly happen. No other alternative is needed. And I think one of the things that a guy like Nick misses there as well is the diversification of strategy inside a portfolio. I'm not attempting to tell anybody they should be only a trend following trader. I think it's a damn good option, but I'm not attempting to tell you that. I'm simply putting information out and saying, does this make sense? Have you heard about this before? Have you seen this evidence? Have you seen these historical track records? Do you know who these people are? Can you learn something from them? It's the challenge. Like I mentioned at the beginning, the 4 Horsemen video. It's the challenge. Reason, argument, debate. Not just letting faith alone be your guiding principle for making an investment decision. If new evidence comes along, adjust, make changes. Big changes, small changes. These are up to you. I disagree strongly with Nick that you must just trust an advisor. What is the evidence that this advising community, whoever they might be in this big amorphous mass called the advising community, why should I just trust them? What have they done for me to give them my trust? What have they proven to me? What have they proven to you? Most of these kinds of people that we're talking about are the same kinds of people that come on TV and make predictions. No one follows up the predictions. It makes for a great headline that day. 6 months later, they make another prediction. Wash, rinse, repeat. It's the same thing on the back of the shampoo bottle. I want to play an excerpt that I heard from investor Carl Icahn.
What is going to happen to that market? Who is going to buy your stocks when those earnings start coming down? And that's with low interest rates, which I think is another scary issue.
The Federal Reserve leaves interest rates unchanged. No rate hike from the Federal Reserve leaves the funds rates unchanged at a range of 0 to 0.25%. It also cites global economic weakness.
The question is, why should they raise rates? And it's almost a rhetorical question. There's so many reasons they should raise rates. Because low rates are, by almost definition, building bubbles, building real estate bubbles, building bubbles even in the art market. Because the Fed balance sheet has mushroomed from less than $1 trillion to over 4.5 trillion, which is a huge, almost unbelievable move. And all that money crowds out. The little guy, the middle class investor, has nowhere to go with their money but into the market, or even more concerning, high yield bonds that are very risky, and they're being sold en masse to the public just as the mortgage-backed securities. So the companies issue these high yield bonds and buy other companies. And in fact, the M&A business, just doing mergers and acquisitions, has doubled from 4 or 5 years ago up to $2 trillion. The irony of lower interest rates is that, well, you think it's going to help create jobs and make the workers more productive. It's not happening. If you look at our companies today, the growth of productivity is at an all-time low. Property, plant, and equipment is older than it's ever been. So we are not taking care of these companies. We are making earnings with financial engineering, by taking over other companies, by low interest rates. And what I say is, at what price? If low interest rates were just that simple of a panacea, we would never have recessions. We would never have these crises. We would never have these panics. And look, I'm not here to criticize the Fed, because the Fed did save us in 08, but then again, you could argue the Fed got us into it to begin with in 02 and 03 with very low interest rates. I mean, it's like giving somebody medicine, and this medicine is being given and given and given, and we don't know what's going to happen. You don't know how bad the end of this is going to be. You do know, though, that when you did it a few years ago, it caused a catastrophe. It caused 08. Where do you draw the line here?
So I have one investor that works with advisors, Nick Murray, saying just trust the system, buy and hold, everything will be okay in the long run. But then I can look at another guy like Carl Icahn, who is worth $21 billion. And Carl is saying, hold on, low interest rates, the positions and direction of the United States Federal Reserve are problematic. Let's pause for a second. Let's look at the details. Now, yes, Carl is looking at the fundamentals. He's making a fundamental decision. He's saying, I'm worried about the fundamentals. I can't really say that. That's not my expertise. I don't know that for sure. My larger point with this entire podcast, though, is decision making and uncertainty. Because stocks don't go up forever. There can be dramatic downdrafts that can change your life, and you don't live forever. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.